Okay, in this video, we're going to talk a little bit about analyzing financial statements. We've taken some time in the last several videos to talk about the actual statements themselves and their construction. Now we're going to talk about what do you do with the data once you have it. So there's several ways we can think about analyzing numbers. We can analyze numbers in what they refer to as a vertical analysis. That is, we can look at a single variable and figure out how that relates to other variables within the mechanism. In other words, we're looking up and down the financial statements to see how things relate to each other. For instance, we might want to know, well, what is the average cost of goods sold for the company? Well, you need to calculate cost of goods sold relative to a number. So let's say we take cost of goods sold and divide it by sales. This gives us a relative picture, if you will, of what percentage of every dollar goes to producing our product. The other thing we can do then is look horizontally, right? Left and right of a financial statement implies history. So we can take this historical picture of our company and determine whether the numbers are getting better or worse over time. What is the growth rate of the numbers? There are many questions we can ask. In addition, we can take this one step further and look at competitors and look at an industry, if you will, to find out how we are comparing to those other entities. So this ratio analysis is essentially trying to find the health of the company. Find those things that we're doing well and maintain them or improve them. And then also find those things that might be weaknesses and try to figure out ways to fix them. So these ratios are really just a relationship. They're essentially, it's like going to the doctor with some symptoms. A ratio is an indication of a symptom. We need to figure out how to solve the problem. There are several different types of ratios. Here we basically have listed 5 different types. There are probably other categories we could add, but these are the 5 primary types of sources. We want to look at something called liquidity. Can the company make its short-term debt obligations? Activity. Is the company acting efficiently? Leverage refers to how the company is financing its operations. Profitability hopefully is self-defining, but we want to find out relative to other numbers in the financial statements how much earnings or revenues or what is the profit that is generated based on some other variable. And finally, we want to talk about market ratios, which reflect how the stock price is reacting to other line items or other items within the ratios themselves. So we've looked at financial statements in the past. You know that there's obviously is an income statement, a picture of the earnings over the period of year. We also talked about a balance sheet. You know, obviously that the assets have to equal liabilities and equity, and there are a variety of component parts. We also talked about a cash flow statement that reflects 3 different types of decisions that management makes. Right? We have cash flow from operations, cash flow from investing, cash flow from financing. So those are the basic statements that we're going to utilize in our ratios. So let's get started with the first set. We're going to refer to something called liquidity ratios. Liquidity ratios measure the ability for the company to pay its short-term debt. So before we get too far into this, let's define some of the parts. Current assets, by definition, are all those things that are going to be turned into cash within the next 365 days. In fact, most of them within the next 30 to 40 days. Current liabilities reflect all the bills that are due within the next 365 days. So this is a cash versus bills kind of a ratio. And of course, you recognize that you need to have more cash than bills. So the current ratio is just current assets divided by current liabilities. The quick ratio is a little bit more conservative ratio in that it subtracts inventory from current assets. Again, inventory is the hardest of the assets to get rid of, so quick ratio gives us a more conservative picture, if you will. So if we look at a company, here's Molson Coors, TAP, and this is the ratio here. If you look across the board, you can see that the Coors' current ratio is less than 1 every year except for 2015. What this means is we want the number to be bigger rather than smaller. We also want the current ratio to be greater than 1. Less than 1 means that the company is technically insolvent. Not that they're going to default, but that they could have some problem paying their bills. So Coors needs to be concerned about this. And what you can see is that although something happened in 2015, in general, we appear to have a downward sloping liquidity for Coors. The quick ratio indeed also shows this downward sloping in the line here, which reflects some decreasing liquidity for the company. So if you're a manager of Coors, or if you're a creditor of Coors, this is something you may have some concern with if you're thinking about maybe trying to borrow some money. Creditors would look at this ratio and maybe balk at giving you a loan. The activity ratios measure efficiency. How well is the company managing its assets? So we're going to first look at some short-term assets. The first one to look at is inventory, right? How efficiently is the company moving its inventory? I prefer to use these numbers down below, the days carry inventory. I think they're more understandable, right? They're easier to get a grip on what the number's talking about. Days carry inventory tells us, on average, how many days does the inventory sit on the shelf. So if you look at this ratio, right? If we look at this ratio, you can see that pretty much for the first couple of years, it's relatively low, around 30 days. 2016, there was this increase for some unknown reason. And then in 2017, again, you can see, but it does appear to have a slightly upward sloping curve here, line. So we may be looking at some slightly longer holding with respect to inventory. So what's wrong with having more inventory? Well, inventory costs more money. If you're a company like Coors, maybe the inventory has the potential to spoil. We have to be concerned about the cost of maintaining more inventory. It's going to have an effect over time on the income statement of the company. Accounts receivable turnover talks about how long it takes for our customers to pay us back. So the number we have here is something referred to as the days sales outstanding. Sometimes also referred to as the average collection period. But again, essentially tells me how long do people owe us money when they buy from the company. Now this formula can vary from textbook to textbook, company to company. And again, it really doesn't matter what the ratio is or what the formula is, as long as you're consistent with using that formula over time. So you don't want to change formula midstream. Once you find one, you want to move forward. So what it looks like here is you can see that there is a little bit of a downward slope in days sales outstanding. So it appears in 2013, the average day is like 63 days. And over time, it appears that Coors has been able to decrease their day sales outstanding. Somehow they've been encouraging people to pay quicker. Maybe they've been eliminating some poor bad debts, right? But in general, they're receiving the money from sales quicker than they used to. And this obviously is good. Right? If you think about an accounts receivable is an interest-free loan. We don't want to lend people money interest-free for 63 days, right? We want to encourage them to buy, but we want them to pay quicker. There's another way to think about these ratios and these efficiency ratios, and that is to think about or talk about long-term assets. So we have what's referred to as the fixed asset turnover ratio. How efficiently are we using our plant and equipment? And the total asset turnover, how well are we using the total assets of the company? So if you think about this, management has purchased assets. The goal of buying these assets is to do a business and to generate sales. Have they purchased too much assets, or do they not have enough assets for the asset base? So we want to measure and look at the relative amount of turnover, right? How efficiently is the company doing? So again, if you look at this number, the blue ratio here is the fixed asset turnover ratio, and you can see that there's been some wide variation. Again, in 2016, something happened in 2016. I'm not really sure what, but if you look across the board, in general, the efficiency for plants and equipment has been relatively high. So they're generating a lot of sales based on their plant and equipment. What I surmise may have happened is in 2016, there was an expansion that they purchased a lot of assets, and it might have taken a little bit of time to convert those assets into the sales of the company. If you look at the total asset turnover ratio, again, it is fairly smooth, a little bit of maybe an upwards tick in trend, but it appears that Coors is maintaining their efficiency and their ability to generate sales given the assets that they've purchased to do that job. So that's the first half of this chapter. We'll come back with the rest of the ratios in another chapter, another video.